We had a reversal yesterday up and then an endless pullback. The bear channel is a bull flag. So the odds were we would get a breakout to the upside at some point today. Here we're getting it on the open. I've been talking about the December 24th high as a magnet. We're going to come down to the December 24th high. What I don't know is if the current sell-off will get us there or if we have to go up higher first and then come down here several weeks from now. Big reversals. We had a big outside up day and then a big bear day, and then today we're reversing yesterday's sell-off. The most important price on the chart is the blue line, the high of last week. Last week on the weekly chart, we had a bull reversal bar, a buy signal bar at the 20-week, at the 8-year bull trend line. It's also exactly at a 20% correction from the high. The bulls want to get above that bar. They're hoping it's just 2 legs down, 1 pullback 2, and a failed breakout below the year-long trading range. I think the market has to get above last week's high, either this week or next week, to see what's there. The daily chart, the reversal up was so strong and the sell climax was so extreme, the odds favor a second leg up. We don't know if the second leg up will simply form a double top here or go all the way up here, the top of the parabolic sell climax. We may simply stay sideways in here. We've been sideways for now 5 days in a tight range, and we're in the middle of the range. We broke above the channel and above the 60-minute moving average. The bulls would like to get an early low of the day. So can you buy above 1? It depends on what it looks like. If it closes on its high with a reasonable bull body, it would have maybe a 25% chance of remaining the low of the day. If it closes on its low, can you sell below? Arguing double top yesterday's high and breakout, failed breakout, I would not. I would wait for at least a couple of bear bars before selling. For the bulls, we've had a lot of trading range trading for 4 days. Reversals. Even yesterday, I thought of as a trading range day. It was a bear trend day. We opened on the high, closed on the low, but it was also mostly a trading range day. Bears want a double top with yesterday's high, break below the neckline, measure move down, and the bulls want the break above the bear channel to resume this bull trend. So bull trend, pull back sideways, and then second leg up. Because of all the trading range trading for 4 days, the odds are we're going to get some trading range trading on the open. Therefore, it's probably not worth selling below 1. If 1 becomes a very big bear bar closing on its low below the 60-minute moving average, then it probably would be okay, but that's unlikely. And it's probably not worth buying above 1 because, yes, we're above the 60-minute moving average, but we're not above this major lower high, and we're not above yesterday's high. If this was up here, traders might be more willing to buy above the high of 1. Globex chart, right below the Globex high. 90% chance we either go above that or below this. Obviously, much more likely we're going to go above the Globex high. So what do? Probably better to wait for another bar or 2. So far, the bar is not particularly bullish. It's not a huge bull bar closing on its high. Yet, the bulls are being asked to pay far above the average price. So it's probably better to wait. Just the gap up, and then even a small bull bar is enough to make it always in long. You can see the bulls are struggling to get a big bull bar. So, in fact, we ended up with a bear bar. So not as bullish as it should be. Not a good sell signal bar. So better to wait for more information. When you get that gap up and a bear close, a lot of traders, depending on context, a lot of traders will just sell the market for a scalp down, betting that it's a weak buy, and therefore we probably have to pull back before the bulls will buy. In this particular instance, I did not sell that close. I'm waiting. The reason I did not is I think the bulls have a good case for higher prices over the next several days. They have a weekly buy signal and a higher low after an extreme sell climax. The market has never had 10 consecutive bear bars. And then we had a very strong reversal up. Odds are we're going to get a second leg up. What happens if 2 closes on its high? That would be good for the bulls, but unless it's a huge bull bar, I think it's not worth paying this much above the average price. Better to wait. Why are we right below resistance? We're above the resistance of the 60-minute moving average, but we're right below 2 major highs from yesterday. Why did we not gap above both of those? Why did we not get an immediate big bull bar on the open? And the answer is the market is not convinced it can break strongly above these highs. I think it's going above yesterday's high. We have an increased chance of a bull trend day because of the buy signal on the weekly chart, but I don't know if we can get all the way up to last week's high. It might be too far above. Here's a 60-minute chart. Here's the high of last week, that blue line. It's 35 points or so from here, and we've had a lot of 50-point days, so it's certainly within reach. But the bulls need to start to create decent bull bars. Okay, Globex traders achieved their goal. They broke out of the Globex range, and obviously a bull trend, bull flag, bull breakout, but a lot of trading range trading here. So this might be a final flag, and we may get pulled back into it. So we broke above 1, but not a lot of aggressive buying. So bull bar closing near its high, not on its high, and decent sized body, not a huge body. So good for the bulls, but is it good enough to be paying that much more than the average price? A lot of bulls do not yet think so. 25% chance we've seen the low of the day. 75% chance we're going to fall below the low of 1. If we get a second bull bar, especially a big bull bar, then maybe 30 or 40% chance we've seen the low of the day. Fairly conspicuous tail on the high of 2, and the body's not all that big. So a lot of the bulls are waiting either for a pullback or for an acceleration up. The bears want either a decent sized bear body closing on its low or a micro double top. Breaking above yesterday's high, good for the bulls. Still always in long. Is it by the close? Well, bear bar 1, conspicuous tail 2, bigger tail 3. So I think the math is not as good as it could be. So not a strong by the close market. The bears want a failed breakout above yesterday's high and a reversal down. On the open, no matter how strong any move up or down is, 50% chance you get an abrupt reversal. 80% of the days you get some kind of a reversal in the first hour or so. but 50% chance a single bear bar can lead to a swing down. To sell below 4, most bears, I typically do not do it. Once I have consecutive bull bars with decent bodies, I typically do not sell the first reversal down. If we get 2 or 3 bear bars, especially bigger bear bars, then it could become sell the close. Bulls trying to prevent bear bodies, even though they've been unable to get bars closing on their highs, they still have 2 consecutive bull bars. Okay, 3 consecutive bull bars, so good for the bulls. The tails are not good, but the bull bodies are good. I said a lot of bears want a second sell signal. However, if we get a bear II, consecutive inside bars, with a bear bar closing near its low, bar 5, that would be a credible sell signal for a swing down. Right now we have a bull inside bar, so a high 1, bull flag, but shrinking bodies and prominent tails increases the chances that we're going to go sideways fairly soon. Yesterday we had a 5-bar bear microchannel. Odds were sellers above. And here we might have a 5-bar bull microchannel. Odds are buyers below. Will most of the bulls scalp, or will this become an even stronger bull trend? I did buy above 4 in an inside bar. If you get a buy the close type of market and then an inside bar, it's usually a decent buy setup for at least a scalp. Opposite's true on the way down. If you have a sell the close trend and a bear inside bar on the open, even not on the open here, bear trend, bear inside bar closing near its low, usually good for at least a scalp. 5-bar bull microchannel, so not a high probability sell. 4 consecutive bull bars. Bodies shrinking, good for the bears. Fail breakout yesterday's high, good for the bears. But 5 consecutive bars without a pullback, odds are buyers below 5. Looks like a lot of the bulls scalp for 2 points, but some bulls might be willing to buy the market and buy above 6, hoping that we get the opposite of yesterday. Tried to reverse, instead we got a big bear breakout. Bears tried to reverse, bulls hoping for a big bull breakout. The target is last week's high. The bulls trying to trigger a buy signal on the weekly chart. 2500 has been a magnet for 5 days or so. 60-minute chart. Here's 2500. You can see we've been repeatedly reversing around it. Bulls hoping this is a bull trend, bull flag, resumption of bull trend. Outside up, 5 consecutive bull bars. What are the chances we've seen the low of the day? By the close of bar 7, 50% chance you've seen either the high or low of the day. And right now it's more likely that we've seen the low of the day. I said 50%. I mean, still, there's a 50% chance we'll fall below the low of 1 at some point. We went above yesterday's high and tried to reverse below 5. The bears would like a second sell signal, so they'd like 7 to be a bear bar. So they want a second reversal down from above yesterday's high. Here's 1, here's 2, gap up. First reversal down, second reversal down. 3 consecutive bull bars. First reversal down, second reversal down. Bears got a swing down. Here, big gap up, strong rally. First reversal down, second reversal down. when you have a strong rally early on and you get a reversal, more likely you get a trading range day than a bear trend. And that's the case today. So if we do get a reversal, even if we get a new low of the day, the best the bears probably will get is a trading range. Very strong rally, first, second reversal, trading range. And right now we have a trend from the open bull trend. Buy the close, buy the market. In a bull trend, if you get a bull bar closing there, it's high. For me, that's a buy setup. I don't take all of them, but I try to take them. Bears, trying to get a reversal. Even if we get a bear bar on 7, it's still a problem. The first reversal below 5, bull bar. If you want to get a reversal down, it's better to get more than one bear bar. Here we had a bear bar and then another one. Tried to reverse down, tried to reverse down again, but we still got a higher high. Tried to reverse down, went up. Tried to reverse down, tail top. I'm trying to find one similar to today, like this. Tried to reverse down, still went higher. So far, a bull trend from the open. They can last a long time. Unusual, about once a month you get a very big bull trend that just keeps going up and up and up all day relentlessly. Is it a parabolic wedge rally? You could argue we went up on one, down on one, and then up here, down, and then up here, down. That would be 3 pushes. I think more likely it's 1 pause, 2 maybe pause, and then 3. So I think we'll get 1 more push up. We may just keep going up all day, but the parabolic wedge top bears probably will wait for 1 more push up. Strong rally, first push, smaller bar, so a pause, bigger bar, second push, pause, third push, parabolic wedge. Up and then doji, second big bull bar, and then pause, and then third push. Bigger bull body, smaller bull body. So first push, second push, third push. This is just a second leg trap. The others were parabolic wedge type of openings. So this is more the kind of thing like that, big gap up. Can this be the high of the day? A low 2, second reversal down from above yesterday's high. I would not take the sell. I think we're probably going to get a third push up. If 5 was a decent bear bar, I would be more willing to sell 8, but 5 is a bull bar, and 6 and 7 are decent bull bars. So it's slightly more likely that we're going to get 1 more push up before the bears can get a reversal. What happens if we get 3, 4, 5 bear bars? Well, then the bears will have created their top, but the odds are they're not going to be able to do that. Always in bulls, it's a buy climax on the open. It's reasonable to get out below any bear bar, but probably there'll be buyers below. So this is not a high probability candidate for the high of the day. Not a lot of bears willing to sell below 8, even though bear bar and buy climax. Bear bar, it's a lower probability buy signal bar, but the odds are we're going to go up at least a little bit more. Odds are we'll get a third push up. Probably sellers not too far above 8 and above 7. Suppose we get an II, then I think more bears would be willing to sell below 9. And II is a triangle, which means it has at least a micro double top within it. Looks like a parabolic wedge type opening. So right now we'll probably get one more push up and then a pullback in our trading range. Less likely we just go straight down. And also it's still possible that we just keep going up, but that is not likely. Bulls, reasonable to get out below any bear bar, bar 8. And bears, while it's a second sell signal, failed breakout yesterday's high. We have 6 consecutive bull bars, and the sell signal bar 8 has a prominent tail below. So I think it's a low probability sell. Surprise bar down, not an especially big surprise bar, but it's still something of a surprise. I think it's still not worth shorting. Trading range more likely than bear trend. The bulls are hoping it's simply a pullback to yesterday's high. Can you buy above 10? 9 is a surprise bar. It's consecutive bear bars. We're probably going to get a couple legs sideways to down. It's enough to confuse the market. Big up, big down. We have 3 consecutive bear bars. Are we always in short yet? No, it's still probably the start of a trading range. We're testing the 6th low, the Y climax low. When does it become always in short? Well, we're still above the moving average. We're still above the low of the day. If the bears get a big bear bar here, maybe always in short. What happened to the 6 consecutive bull bars? Remember, I said on the open, 50% of the time, if you have a strong trend up or down, you get an immediate reversal. So 50% chance the bears would get a reversal down without a micro double top. Trading range more likely than bear trend. With that in mind, can you buy at the market with 4 consecutive bear bars? I would wait for the selling to stop instead of just buying and buying more lower. For the bulls, a high one, a pullback in a bull trend, but a 3-bar sell-off, pretty deep sell-off. Difficult to trade. I'm flat. I was looking to buy, but I don't want to buy this high up after big up, big down, because the trading range is likely, and that means there probably will be sellers not too far above. We're getting near the end of the first hour. Bulls trying to create as good a bull bar as they can get. We have a bull trend, breakout, a pullback, and then a breakout above this bull flag. The bulls want a big bull bar, and they want to get above the top of the range, which is last week's high. we have a buy signal bar on the weekly chart. I hate missing the reversal up, but I did not put an order to buy above 10. I obviously did not sell, but I did not buy either. So right now I'm trapped out. Totally erased the bear reversal. But when you get these big swings, a lot of traders naturally become risk adverse because they're worried about another big reversal. And that's one of the fundamental problems with the daily chart. When I hear people talking about how the low is in and how we're just going to go straight up, most traders, most individual traders, a lot of institutional traders look at those big moves and the big reversals and are not confident that the market is going to switch into a bull trend. And therefore you have a lot of traders unwilling to buy and unwilling to buy high. Very good bar for the bulls, right? The huge bull bar closing up near its high. So it's a buy the close, buy the market type of bar, but the risk is very big. You can see we're trying to trigger the buy signal on the weekly chart. There's last week's high. Measured move. Measured move takes us above last week's high. Surprise bar, odds are we'll get at least a small second leg up. The bears want another reversal, a bigger low 2 with bar 8, but surprise bar, big magnet above. So low probability sell below 12. If we get a huge bear bar, traders might sell it, but right now probably buyers below around the 7 high. That's about a 50% pullback. I am buying. When I see this kind of strength, I buy. You can hold for a swing. I've been buying, scalping. What are the chances it's a second leg trap like yesterday, 26? I think maybe 30%. Bar 12, close of the first hour. Good bull bar closing as high. Bulls trying to break above the top of the range, which is last week's high. So they'd like a strong second hour today. That would increase the chances that we're going higher. I think we're going to get above the February low. I think we'll get to this sell climax high daily chart, which means that low. We may get all the way up here at the top of the parabolic wedge. Very close to last week's high. Buy signal bar on the weekly chart. We have that other high just below. I don't really need the 2 lines, so I'll get rid of that one. I think the more important one is last week's high. Bears want the second leg trap. Bulls, because of the possibility of the second leg trap, will get out below a bear bar. They'll get out 6 or 7 or 8 ticks below any bar, even below a bull bar. Bears, some bears will take the short, arguing we're at resistance, last week's high, and possible second leg trap. Even if it's only a 30% chance of being the high of the day, if the risk is 5 points and the reward is 20 or 30 points, it's a profitable strategy. I would wait for a second sell signal. The reversal up 11 is so surprising. The odds are the bears will need at least a micro double top. The odds are we'll get at least a small second leg up. Remember, a second leg trap is a trap. That means it has to look very bullish to trap bulls into buying high. 30% chance this is a second leg trap and the high of the day. 70% chance it's not. 70% chance the bears will need at least a micro double top. Similar to yesterday, weak rally, strong breakout, failed. Here, problems with the rally, not ideal, and then very strong bull breakout. Can you buy the 13 low? I would not do it. 30%, if you have a 30% chance of being shot, you got to do something, right? So you have a 30% chance of a huge loss. I would, I think, buying that low is not worth it. A lot of bulls will hold and wait for 2 or 3 bear bars, but I think it's reasonable to get out because the bar closed on its low. Always in bulls, what do they do with 13 or 14? If they get out, do they buy again above 14? If it closes on its high, it's a reasonable thing to do. But big reversal down 13, we may get a couple small legs down before the bull trend resumes. And for the bears who sold below 13, I thought I would not do it. The math is not good. They have to get out above the bull bar, or they have to get out above the bull bar closing near its high. They don't have to. They could get out above 13. It's really interesting how the bears were able to create such a good-looking sell signal bar. Sometimes I believe a good-looking sell signal bar is created by bull computers trying to trap bears into selling, and then the bears have to buy back their shorts. So the bull computers create bar 13, for example, with limit orders to buy the 13 low, and the bears are selling just below 13, and the bulls that create that 13 bar are confident that they can overwhelm the bears, that there will not be enough bears taking the short. Bond chart, parabolic wedge, and outside down. So wedge 1, 2, 3, outside down. So this is probably the end of the rally for the next couple of weeks. We'll probably trade down here, potential final flag. For the bulls, high 1, probably going higher, but big enough bear bar 13, we may pull back for 2 or 3 small legs. So not a great buy, and I would not be short. I would not take that short. High 1, but a doji after a big bear bar. So most bulls are not going to buy above 14. The bulls who did not get out, their stop is still all the way down here. They're not going to let it get hit, but that's where their stop is right now. Bar 15 is a multiple of 3. So its close affects the appearance of the 15-minute bar. So if 15 closes on its low, then the bears will have a decent sell signal bar on the 15-minute chart. Confusing, and when things are confused, it's usually better to wait for a second buy signal or a second sell signal. Odds still favor at least one more leg up after such a surprisingly big outside up bar 11. Plus we have an important magnet just above. Bar 15 closed on its low. So the 15-minute bar is a decent sell signal bar, but the context is not all that good. We have a surprisingly big outside up bar 4 and a target above. Odds are we're going up. Not a good buy signal bar 15, but always in long, and we should go higher. So the math is difficult. The probability is less buying above a bear bar 15. Probability is less after consecutive or two bear bars 13 and 15, but it still favors at least one more new high. What happens if we just collapse and totally reverse 11? Well, traders will change their minds. They'll conclude that this is the high of the day. But right now, we're probably going higher. You can see not a lot of bulls bought above 15 bear bar, plus that there's the other bear bar 13, but we're still always in long. The bulls now have a bull bar 16, but fairly prominent tail on top. But the odds still favor the bulls, even though the probability is less. In general, it's higher probability to buy above bull bars that close near their highs. Here, we might be entering a tight trading range. Suppose 18 closes on or near its high. I think the bulls have to get long above a bull bar. I don't know that the math is good enough for a scalp, but for a swing, yes. Tough buy, probability not great, possible tight trading range. I think the bears should get out above 18. Bulls can buy or they can wait. Bears will try to get a second sell signal below 19, but they would need a pretty good bear bar to attract sellers. I did take the buy because of the bull bar closing there its high. We're still always in long. I was not happy with the buy, but it made sense. Whenever the 5-minute chart triggers a buy signal on a higher time frame chart, 60-minute chart, weekly chart, usually there's a pullback below the entry price within 5 or 10 bars. So we'll probably get a pullback soon. The bears, a wedge top. I said second leg up, likely after 11, and this qualifies, and possible wedge 1, 2, 3. This is so strong, it might have reset the count, so this becomes 1, and then this is 2, and then maybe a pullback, and then 3. Bulls buying strong closes and buying above bull bars closing on or near their highs. Possible wedge, but more likely we'll get at least one more push up. Sometimes you get these wedges that do not look like wedges, but it's 3 pushes up. Reversal, 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 wedge. Wedge, trying to find one similar to today. This is kind of like it. We're 0.1 and 3. There's a big overshoot, 0.2, and that's similar to today. So you got 0.1 and 0.3 with a big overshoot on 2. That's a bad shaped wedge. For the bears, it's another short. They had a short below 8 or 9, a short below 13. And since this one now is a possible wedge, it has better probability than the other two. But 18, 19, surprisingly strong. I would not sell below 20. Remember, I said that when you trigger a higher time frame buy signal, there's typically a pullback within the first 5 or 10 bars, and then another attempt to trigger the buy signal. Bar 18, we broke above the 18 bar range right here. And if you fail, if it breaks above the 18 bar range and then reverses down, the reversal usually comes within a bar or two of the breakout. So if it's going to fail, it would make sense that it would fail right around now. But I still think the odds are we'll go at least a little higher. And therefore, while it's a reasonable short below 20, I think the math is not good enough. I would wait for a second sell signal or for a series of bear bars. This is what the bears see. I1, but bear body, might be sellers not too far above. Possible wedge, 1, 2, 3. I'll leave this here, but it's also, I think, a better wedge, 1, 2, 3. I'll wait, see what we get. And even if we do get a reversal, more likely it'll be minor and lead to a trading range. So possibly a trending trading range today. Not really a trading range, but we had something going on here, weak rally, sell off, and then a breakout, and then problems with the rally, bear bar, dojis, bear bar. So this might end up forming a trading range here. Why would we stop here? Because a lot of bulls are unhappy with the bear bar 20, and they can count. They know it's 3 pushes up, 1 or 1, and then 2 and 3. And also, as I said, we just triggered a buy signal on the weekly chart, and traders know that you typically get a pullback before the market goes much further. And we had 5 trading range bars here and another one here. So this rally might be a bull leg and a trading range. And right now, the bulls who bought above 20 have a 5-tick trap. And that means not a lot of buying going on above 20 and above 19. Outside down. For the bears, it's a sell, but not a good one. I would get out of longs below 21. And while it's a wedge and a possible high of the day or the start of a swing down, we have a failed breakout of the 18 bar range. I'd like to see more selling. In terms of scalping, I bought above 20, decided it was done, and I placed a limit order to get out break even, and I got out break even. And on the reversal down, I sold, and I've already scalped out. I sold as soon as it started to pull down because I thought the bulls would be quick to give up. That's an example of almost a reversal trade. Then within seconds went short, and then I scalped out back to flat. But definitely good for the bears. Wedge, failed breakout, 18 bar range, and a pretty good give up bar here. Bulls giving up. It wasn't short yet. If I were in the market right now, I'm not. I would be short. And right now I'm looking for a sell scalp. I'm redrawing the wedge, but you can do it either way. I think some computers are using the bigger wedge, others are using the smaller wedge. Bulls trying to trigger a high 1 buy signal. They're hoping that it's 1, 2, and 3. But with that big upside down and possible wedge, I'm trapped out. That's 3 consecutive bear bars. Are we always in short yet? I still think the bears need to do more. It's similar to 8, 9, 10. What's different is we now have a credible wedge. The market's deciding, is this a wedge top, or is this 1 pullback, 2 pullback, 3? Market's deciding, do we get one more new high before a reversal? At the moment, I think that we will. Bulls will try to turn this into a trading range and prevent the bears from creating a bear trend. So probably buyers are on the moving average and the 16 low. Now 4 consecutive bear bars, 3 bear bars down from the high. Probably the first bounce traders will sell. So probably at least a small second leg down to around the 16 low. Good bull bar, sellers above. Decent bull bar, sellers above. Decent bear bar, probably buyers not far below. Decent bear bar, 13, buyers not far below. So we're probably going to get a bounce here or soon. Trading range more likely than bear trend. Second leg down likely after 3 decent bear bars and 1 closing near its low. Tight trading range, reasonable candidate for the high of the day. Typically, after you trigger a buy signal on a higher time frame chart, you trigger it again later in the day or certainly the next day. So the odds are either today or tomorrow we'll again try to get above the blue line last week's high. This is not a very good buy. We have 4 consecutive bear bars from the high, 5 consecutive bear bars. We have a wedge. We're probably going to get a second leg sideways to down. It's possible 26 is the second leg down, but I suspect that it's not. I suspect that we'll get 1 more test back down. Are we still always in long after the 4 bear bars? We haven't touched the moving average in 28 bars, so we're probably still always in long. But so what do you do here? I'm flat. I thought there'd be sellers above 24, and there were. I think it's less certain now that we have a micro double bottom. Down 24, up 25, down 26. Possibly limit order trading. I'm flat. I think it's slightly more likely that we'll get a lower high, a head and shoulders top. But when you trigger a buy signal on the weekly chart, typically you get a pullback and then you trigger the signal again. And at that point, the market decides whether to successfully go above last week's high or to reverse. So we should get above the blue line either today or tomorrow. The bulls are trying to get there here. 11, a big enough surprise bar. We've probably seen the low of the day. Also, we broke out of the 18 bar range, so only 10% chance we're going back to the low of the day. That means the question that we have is, are we in a trading range, or is this a pause in a bull trend? For the bulls, double bottom bull flag, neckline here, they want to measure move up, and for the bears, a wedge top, and 5 bear bars, they want a second leg sideways to down, but unlikely to get a bear trend. This is an attempt to trigger the buy signal a second time. Is that a higher probability buy? Can you buy 1 tick above the blue line? I think we're in a bull channel and a trading range, and I think I'd rather be buying low or wait to see a strong breakout and buy higher. Very strong 11, 12, and we have a higher low here, and probably 50-50 chance we get a second leg sideways to down and form a trading range. 50-50 chance we just keep channeling up. So keep getting new highs, pull back, new highs, pull back. You can see we went about a tick above last week's high and again reversing down. The bulls are hoping 30 is a pullback in a bull trend. and the bears were hoping that we're getting a double top, slightly lower high, major trend reversal, head and shoulders top. The bears would like a reversal into a bear trend, but after 11, 12, more likely the best the bears will get is a trading range. So right now I still think the decision is between either a trading range or a bull trend. And if we get the trading range, let's say we're sideways for a couple hours, 3 hours, later in the day the market will decide between trend resumption up and trend reversal down. Because the breakout above last week's high was small and brief, it's a weak breakout. So we triggered the buy signal, but this is all we have. One bull close above last week's high and only 3 bars and a reversal. So that is not the way strong breakouts typically look. This is how a strong breakout looks. This is a 5-minute chart breakout, but we could have had a huge breakout 20, 30 points above last week's high. That would have been a strong breakout. Instead, we're a couple points above and immediately reversed down. So for the bears, a lower high, major trend reversal, head and shoulders top. 3 consecutive bull bars, bodies getting bigger, always in long, so low probability sell. It's still mathematically okay, but more likely buyers not far below 29, not far below 30. $60-minute chart, we're struggling to break above the top of the range. We broke below the bottom of the range and struggled. We went sideways instead of down, and the opposite so far is taking place at the top of the range. We're going sideways instead of up. Tail on the bottom of 30, so lower probability sell. And for the bulls, it's another high one like 20, a bear bar at resistance last week's high. So not a strong high one buy and not a strong head and shoulders top sell. Probably buyers not too far below 30, maybe at the moving average. We've not touched the moving average for 30 bars. Can we stay above the moving average all day? No. Why can't we? Why can't we just stay above for 81 bars? Because it does not happen, right? You can look at the strongest trends going back for years, and maybe once every 2 or 3 years, once every 500, once every 1,000 days, you'll get a day that does not touch the moving average. But no matter how strong a trend is, you have to assume it's going to touch the moving average, because it almost always does. So we're going to touch the moving average. Say it's a decent trend, but it's not an incredibly strong trend. And even incredibly strong trends come back and touch the moving average. So we're going to touch the moving average. We don't know if we're going to touch it now or go higher and then touch it, but we're going to touch the moving average. Now let me do it this way. An extremely strong bull trend. But look, 60 bars out, it got 65 bars. It got back to the moving average. So no matter how strong a trend is, it's always going to come back to the moving average. Huge gap up, trend from the open bull trend, small pullback bull trend, touch the moving average. And these trends are much stronger than what we have today, yet all of them eventually touch the moving average. When we touch the moving average early and again late. Touch the moving average, right? So every day, it's going to touch the moving average. No matter how strong it is, it's going to touch the moving average. And even if it rallies all day, it's going to touch the moving average at some point. If 30 closed closer to its low, I probably would have sold for a scalp. You can tell the market is aware of last week's high. We got near it, reversed down, went above it, reversed down. went above it and reversed down. The bulls have been willing to pay above the average price for 30 bars, and though there will be bulls happy to get an opportunity to buy at the average price, so unlikely to collapse here. Bulls trying to create another higher low. What happens if we fall below 25? Well, then we no longer have a higher low, and it would significantly weaken the bull argument that this is a spike pullback channel, and it would make it more likely that it's a spike trading range. And then later in the day, we either get a reversal down or a resumption up, or we simply stay sideways and wait until Monday. So the 25 low is important. The bulls want a bull trend, and a bull trend needs higher highs and higher lows. If you start getting lower lows, you're probably either in a bear trend or a trading range. Today, trading range is more likely. We've been in a trading range for 20 bars now. Not a very good stop entry buy. The bulls have a higher low, and they see 31 as a pullback from the breakout above last week's high. But 32 is forcing traders to buy at the top of the trading range. Not high enough probability for a scalp. So it's either a swing or you wait for the breakout and then buy higher. So you wait for a bar like 11 and then start to buy again. Can you sell the 32 high, arguing we should get to the moving average soon? I would not. The bulls have enough strength to, I think, make it not worth taking that sell. You can see the hesitation. A lot of bulls, like me, did not buy above 32. Too much risk of a limit order market buying at the top of a tight trading range. What happens if we get a bear bar 34? Then we'll have a triangle. Right now it's still always in long, and bulls trying to break free of last week's high. But so far the attempts are weak. 1, 2, 3, and so far 4. We could suddenly get a bar like 11. That's what the bulls are hoping. Pretty common if you're in a tight range to get a double top lower high major trend reversal. I still think the odds favor higher prices, but if we get a bear bar 34, that would be a reasonable short. The higher we go above 29, the less willing bears will be to sell below 34. It would have been better if they had a perfect double top, which they do not have. Good bar for the bulls, right? They want a follow-through bar. Whenever you get a breakout, a big bar closing above something important, there's higher probability of the market going higher, like for a measured move, if the next bar is also a bull bar. The bears will try to create a bear bar. They want to get a failed breakout. They tried bar 13, they tried bar 21, and failed. What about limit order bears selling 21 high and scaling in higher? The math is probably okay. The market does not have that much energy, so limit order bears will probably make money. But we're always in long, so there's always an increased chance of a surprise, and surprises usually occur in the direction of the trend. So bar 11, we're in a bull trend, the bears try to reverse, we get a surprise bar. Strong rally. Well, that's interesting. Ticks hit 1,000, but look at this. We got about a 15 bar bull microchannel, so odds were high that there'd be buyers below that bar. Ticks hitting 1,000, the highest tick reading looks like maybe all day. the first pullback probably will not get very far. So this is probably not going to be the final high in price. For the bears, another wedge, 1321. Strong trends are constantly forming wedges, and most of them do not lead to reversals. So that is not reason enough to short below 35. You can argue nested wedge, 1, 2, 3, and then 1, 2, 3. But I think low probability short. Limit order bears probably selling new highs and scalping. Bulls hoping that this is a gap and that we go up for a measured move. Odds favor the bulls. Traders will keep buying pullbacks. A lot of them take profits at new highs. What about buying the 35 low? I would not. I'd buy closer to the moving average. We got close to the moving average here, here, here. High one, but you need a wide stop down here to allow for a couple legs sideways to down. Far above the moving average, probably not the best place to buy. You can certainly do it for a swing, but in general, in a trend that's not especially strong, it's better to buy deeper pullbacks. High one, but you still need to stop down here or here. Still a possible top of a trading range instead of simply a measuring gap looking for a second leg up. 1 minute chart, an extremely high tick reading, unlikely to be the final high. Typically you get a pullback 5 or 10 bars and then at least one more new high. And so far this high has a lower tick reading, so fewer stocks going up, but it's still strongly bullish. We still have a lot more stocks going up than down. I mentioned last week that a couple of the targets, several targets above on the daily chart, moving average February low, and then this sell climax high, which is also this early December low. And I said I thought we'd get above the February low, but stall somewhere around here. So somewhere below or around 2,600, I think, is where the market will reach. For dojis, so a lot of the bulls are not confident that it will go a lot higher, and the bulls are scalping, and you have some limit order bears selling above bars, above 35, looking for scalps. Stop order bears, 34, strong enough for a second leg up. This qualifies, just like 11, 12, strong enough for a second leg up, and this qualified. So we might get a pullback in the next few bars, but the odds are it's going to remain always in long. Next target, we have a gap here, so we might get a measured move up there. If we get a bear bar 40, it would be a higher probability short than the bear bar 35, because we're likely to get a second leg up after these 3 bull bars, and this would be the second leg up. Is it worth shorting? I don't think so. Look how tight the channel is. We had a 1 bar pullback, too small, 2 bar pullback, but very shallow. So bears selling are selling with limit orders more than with stop orders. Better to buy a pullback. We're going to pull back to the moving average probably some point in the next hour. This could be the start of it. But better to buy the pullback. It's a type of low 4. 4 pushes up, 1 pullback, 2 try to top. Instead we get a breakout, and then 3rd push, 4th push, but it's a small pullback, bull trend. Really difficult to make money shorting when the pullbacks are small. So traders are buying. We're, I think, far above the moving average. It's okay to wait to buy a pullback. For bulls who are holding long, it's also okay to get out below a bear bar, thinking that one of these pullbacks is going to reach the moving average. Even if we get a reversal, even if it's 5 or 10 bars, the odds are we'll remain long. There'll be buyers around the moving average. We've been above the moving average for 40 bars. Bulls have been happy to buy above the average price for a long time. If they get a chance to finally buy at the average price, they'll probably take it. You don't have to get out below 41, but if it's a bear bar, I would, and then just wait to buy closer to the moving average. High of last week, resistance, 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 support. So it might be support. Maybe we'll test it again. Small pullback bull trend. So can you buy the 41 low? It's a small pullback bull trend. Chances are the pullbacks will continue to be small, but we may get pullbacks that last more bars. So in other words, pull back a bar or two, but go sideways for 5, 6, 7 bars until we get closer to the moving average. Not much downside risk when the channel is this tight. Usually the bears first have to stop it from going up and then make it go sideways for a number of bars, and then they have a chance of a deeper pullback. Getting near the target, I don't know that we get there. I think we probably will. We might pull back first. Reasonable to get out of longs here. It's a 4 push up. We have a second push up here, so it's a small spike pullback wedge channel. Does not look like a wedge, but it probably is a wedge. So I would get out of longs at the market and then look to buy again around the 37 low, the moving average. Is that close enough to the target? First of all, I don't know if I have the target drawn in perfectly. Typically, I like to see the market get to within a tick of the target. And we're not within a tick of the target. So we still might have to get higher. You can see we're more than a point from the target. We're still about 5 ticks from the target. With the range being as big as it has been lately, it's possible that instead of 1 tick, 5 ticks might be enough for traders to consider the test as adequate. But stop making money on selling with stops, I would not do it. So even selling with limit orders, really hard to make money when the pullbacks are as tiny as they are. That green line just above is the February low. Bulls are trying to get back above the February low. Let me make sure I have it drawn in correctly. Yeah, that's pretty close. Don't even have the February low drawn in here. Daily chart, weekly chart, we broke below it, and we have a reasonable chance of getting above it today. Traders are still buying. I'm flat. I'm not taking a buy in several bars. I'm waiting for a pullback. Can you sell and sell more higher? Of course. And you probably will make money if you use a wide stop, but your stop might have to be 20 points. I think it's not worth selling when the pullbacks are as tiny as they are. We still have a lot of time left. The market often pulls back between 10 o'clock and 11:30. So we're in that window when it often stops going up. It doesn't have to pull back. It could simply go sideways for 5 or 10 bars and get to the moving average. So we're in a window when I think it's more likely than not we're going to start to go sideways. But right now, I think I would say at least 50-50 chance we're going to get up to the February low today. I don't know if you noticed, but we're up 90 points. So a lot of that is the gap up, but it's still a very big bull trend day. Daily chart, resistance, moving average, resistance, February low, just a little bit higher. Bulls trying to get a breakout, and then they hope for a measured move up. Takes us to the top of the parabolic sell climax. I do not think we'll get there without pulling back first. But traders are buying at the market knowing that even if we reverse down sharply, this will probably not be the high of the day. We'll probably still go above where we are. The reason traders buy this is because they're confident we're not going to get a bear trend without at least a double top. And therefore, they buy at the market, confident it'll either go up and they make a profit, or it'll go down, they buy more, and it will come back to this price later on. So the probability is high for making a profit. Profit-taking zone, climactic, unsustainable, probably sideways to down soon, if not here. It's still buy the close by the market, but you need to stop probably below 37, maybe below 31. And you have to be willing to add on lower. Remember, the market often stops trending going into 11:30, and sometimes it stops at 11 o'clock. More often it stops earlier, and this is extreme. So it's probably going to stop soon and either go sideways or pull back. And it will hit the moving average at some point today. For the bears, a pullback and a bull trend, so it's a high one buy, but it's I think unsustainable. So I suspect there are more sellers than buyers above 15. I would wait for a couple legs sideways to down to near the moving average before buying again. Aggressive bears can sell for any reason, but they probably need like a 15-20 point stop. And they have to be scaling in, and they're not going to make much profit, so they're probably scalping for a point or two. High one, small pullback bull trend, but I would wait to buy closer to the average price, so I'd wait for a second buy. Probably a tight trading range here since our 40, 41, trying to get smaller bars. Two small legs down. But I suspect we're starting to convert into a tight trading range. So I think a lot of the bulls will be scalping. Looks like bulls scalping, and it looks like limit order bears selling. So probably sideways to down to the moving average over the next several bars. You buy the 49 low, not worth it. We know it's going to the moving average, so why buy there? Bulls might try to get a high 250. But I would not take it because we're so close to the moving average that we probably cannot escape the gravitational pull. We probably have to get there. Bears might be creating a bear breakout, but it probably will be a trap, an end of the day bear trap. When you have a small pullback bull trend and you get a pullback to the moving average, it often has a couple pretty good bear bars. And it looks like the bears might be getting a reversal, but most of the time it's a trap, trapping bears into hoping for a trend reversal, and instead the sell-off becomes a bull flag. Small pullback bull trend, bears get bear bar, but reverses around the moving average. 5 bear bars and still reversed around the moving average. 3 bear bars. You want to look for a bull bar closing on its high, and you buy above the high of the bull bar, looking for resumption up, a collapse, still reversed. So more likely a bear trap and not the start of a swing down. What do bears need to convince traders that we've seen the high of the day and that this is going to be a successful swing down? They need bigger bear bars. They need consecutive bear bars, 2 or 3 consecutive bear bars. We have a spike pullback channel. We may come back down to the high of last week, which is at the bottom of the channel. We're in the buy zone around the moving average, but there's nothing to buy yet. Bulls want a bull bar closing around its high. Can you buy at the market? I usually wait for a bull bar closing on its high. Can you sell down here? No. This is more likely a bear trap than a bear trend. So it's more likely to reverse up than to continue down. If we suddenly get a very big bear bar or 3 or 4 bear bars, then the bears will have probability on their side. But without that, it's more likely a bear trap, a bear breakout that's going to fail. Strong bear breakout, buy above a bull bar, bull bars closing near their highs. Another attempt by the bears, buy above bull bars closing near their highs. Pretty strong selling, buy above a bull bar closing near its high. Sometimes this is what the bears are hoping. They're hoping that instead of a bear trap, it's actually a reversal and the bear trend continues down. So bear trap and a small pullback, bull trend, but we actually got the reversal. Maybe that's 30% of the time. A bear trap became a bear trend. Suppose it's a small bull body with a prominent tail. I think the bulls should wait for a bull bar closing near its high. If you're a bear, what are you thinking now? You're thinking, darn, fooled again. It's a 20 gap bar buy, so we know there are buyers here. And bear trap is more common than a reversal when you have a small pullback on bull trend day. You can see a lot of bulls simply bought the moving average or bought the second bear close, betting that we would not get a third or a fourth. If you buy above 52, is your stop below 52? It probably is, but there probably are buyers below 52, so we may get a couple legs down, 50, 51, pull back, and then one more push down. First reversal up did not get far, but there were buyers below the low, and second reversal up was better. First reversal up did not close on its high. Here, closing on the high, that's a better buy. Closing on the high, you buy that, or you wait for a second or third. Closing on the high, inside bar, or you can wait for one closing. This is not on the high, but this is closer to the high. Similar to today. Might go sideways here. The bears are hoping for a small pullback bear trend, but the odds are we're going to go to a new high of the day. For the bulls, do they get up below 52, or do they use a wide stop on 31? Well, it's tough because there probably are buyers below 52. Can the bears sell below 53? I would not. Odds are we're going to a new high. Sometimes it goes sideways before it goes up. Here we have a bear bar. Here, weak initial rally, but still eventually worked its way higher. Bears hoping for a small pullback bear trend after the small pullback bull trend, but more likely buyers below 53, buyers below 52. We have an important target above, and we have a couple hours left, so we could go sideways here more and then go up there. 30% chance we just keep drifting down, maybe all the way back down here. The best bull trends would not pull back below 52. The bulls would buy above the 52 low and defend that low. And I still think that is likely. I still think it's not going to fall below 52. The bulls know traders will view the day differently if it falls below 52. The bulls were strong enough to do this. And if they're not strong enough to stop it here, then it significantly reduces the chances of an end of the day rally. Bulls need two things. They need to prevent it from falling below 52, and they need another bull bar closing near its high. And the bears need it to get below 52. Even our ticker 2 below 52 will reduce the chances of a new high. So we don't yet know if the bulls are still in control. They probably are. A chance of a breakout, because this will change the perspective if the bulls are not strong enough to defend their stop. You have some higher time frame traders trading as well, not just day trading computers. The bears are trying to maintain the gap below the February low on the daily and weekly chart. The bears on the weekly chart, for example, want a measured move down, and they like no overlap with that February low, so they want to keep the gap open and then reverse it down. Microdouble bottom, but not a bull body, so not nearly as good as the bulls want. You got some disappointed bulls concerned by the bear bar 53, 54, and a lot of them are trying to get out with a smaller loss, like a 1-point loss or a 2-point loss, but the probability still favors the bulls. Bears getting a breakout, again testing last week's high. Last week's high is important. It's a buy signal bar on the weekly chart. Today's Friday. And end of the day, the market often decides whether to close above or below weekly support or resistance. We have resistance up at the February high, and right now, last week's high is support. And the market may end up just going sideways. We've been sideways now for 20 bars, 25 bars, 20 bars here. And we're at the bottom of the range. I still think the odds are against a bear trend. Four consecutive bear bars, so that's bad for the bulls. They will buy again above a decent bull bar, a bar closing near its high. And for the bears, in the absence of bigger bear bars, I can't short down here, so I'm only interested in buying. We tested last week's high from below, and we tested it from above here, testing it again here. To buy, bulls want a bull bar closing on its high. Fairly tight bear channel, so not high enough probability for a scalp, but an okay buy. So you buy above 57 if it closes on its high. If you want higher probability, you wait for 58 or 59 to see if we start to get 2 or 3 consecutive bull bars. And for the bears, we're selling off, but I still think we're always in long. The bears have not done enough to convince traders that this is the start of a bear trend. It still looks more like a bear leg in a trading range, and the trading range is in a bull trend. 4 consecutive bear bars, 56, break below 52. I think a lot of bulls will hesitate buying above 57. They'll wait to see if 58 or 59 are also bull bars. Limit order bulls bought the 52 low. They made money. That was likely. The character of the market changed with bar 35. We started to get smaller bars, more overlapping, and that's what we've had since then. So it looks like a trading range, not a good stop entry buy. And for the bears, they're hoping this is a small pullback bear trend, but they need to get a couple consecutive big bear bars closing near their lows to convince traders. Otherwise, it's more likely a bear leg in the trading range. 2 bull bars. The first one, 57, has a tail. It's a wedge, 1, 2, 3, a test of last week's high, but a tight bear channel and a tail on top of 57, not very good. 58, a better bar, but still not especially strong. I still think we're always in long, but I'm going to wait to get maybe one more bull bar or have it go sideways more. And for the bears, I don't want to be shorting at the bottom of a trading range. If we break strongly to the downside, then I'll short. For the bulls, always in long. So some bulls are buying, others are concerned about the tight bear channel and the market falling below 52. So they're waiting. Good bar. So far, a good bar for the bulls. They want to get all the way up to the February low. The bears want a lower high, and they want the week to close below last week's high. Bears want double top, 53, break below neckline, measure move down, and bulls want a continuation up to the February low. You can see the disappointing behavior, and that's characteristic of a trading range. Whenever you want the market to do just a little bit more up or down, yet it does not do what you think is likely, that's a sign that the market is still in a balanced market, so it's still trading range price action. Small bars, small bodies, lots of small reversals, all trading range price action. So for the bears, double top bear flag 53, but still always in long. Probably buyers below 59 or 60. In general, a double top bear flag has a 40% chance of breaking below the neckline and falling for a measured move down. That's when there is a credible bear trend. I think the probability is less than that today because this is not clearly a bear trend. So probably less than a 40% chance we break below 56 and fall for a measured move. That means more than a 60% chance we either stay pretty much around where we are or go higher. Still working higher, still always in long, not strongly bullish. Bulls trying to get up above the February low, and the bears hope to maintain the trading range and get the day to close below last week's high. Up is more likely than down. For the bears, lower high, major trend reversal. In general, a reasonable looking major trend reversal has a 40% chance of actually reversing the major trend, in other words, bull trend to bear trend. 60% chance it will not. This is probably less than 40% for the bears. Small pullback bull trend day. Usually, the odds are less than 40% that it will reverse into a bear trend. You short it if you want to take a chance on the top. Well, better to be selling below a bear bar closing near its low and not a bull doji 62. Bulls bought 62 low and scalped. Breaking below a bear outside bar, but the outside bar is only a doji, so not a reliable sell setup. Good bar for the bears, but they need more. Not a good sell below 62 or 63. Surprise bar down, but we're still above the 56 low. You can see we've been sideways for 30 bars now, deciding between going above the February low and ending the day above or below last week's high. Last week is a buy signal bar, big tail on top, so not as strong as it could be. Also, two very big bear bars. That weakens the probability for the bulls. Bulls trying to create signs of strength, and one sign of strength would be closing above the buy signal bar high, which is the blue line. What do you do here? I'm flat. I did not sell, and I did take one buy scalp on the way up, I think during 59, but that was it. Big tail on the bottom, so weakens the bear argument. Bulls are hoping 64 is a pullback from this breakout above this wedge bull flag, and bears are hoping it's a lower high major trend reversal and the start of a bear trend. More likely, or most likely, it's just a big bear bar in the middle of a trading range, and the market has not yet decided whether to close below last week's high or right now less likely above the February low. Looks like last week's high is the key price. The bulls tried to break free of it over here, but came back to it, coming back to it again. Bears trying to get it back below last week's high. They don't need a bear trend. It's obviously a major trend reversal setup, but all they need is a close one tick below the blue line. I think it's unlikely that we'll get a bear trend. We've been sideways for 3 hours. I think the whole issue is whether or not the day closes above or below the blue line. We tested it from below several times, broke above it. We're testing it several times from above, and we still don't yet know if we'll go below it or rally into the end of the day. We're starting to accumulate a lot of bare bodies. That lowers the chances of a rally into the close. To buy above 66, the bulls need a decent bull bar. Unlikely to get it. It looks like most of the bears 65 scalped. Pretty abrupt reversal up at support, but it looks like we'll probably end up staying in the range for the rest of the day. Buy above 67 if it closes on its high. The reason I would not is two reasons. One is it would be in the middle of a trading range, and we had 4 consecutive bear bars. You can call it a triangle. Can you sell above 66 with a limit order after 4 bear bars? I would not. We're at the bottom third of a trading range. This is the buy zone. The buy setup is not very good because of the 4 bear bars, but I would not sell. For the bears, a lower high and a triangle, but just above support. And we've been sideways for a lot of bars, so not a high probability sell. For the bulls, 68 is a pullback from the 67 reversal up. We're at the apex of a triangle. It could go either way. We're probably not going to go very far either way. A lot of times when you have significant support and resistance and significant higher time frame things going on, like a weekly buy signal, in the final half hour, you get a big move. So 12:30, 12:35, you get a breakout, either trend resumption up, trend reversal down. So, that is something to be aware of, that we may stay sideways for another 20 minutes and then get 4 or 5 bars up or down, up to the February low or down to the 60-minute moving average. Another buy signal bar, still, I think, always in long, but relatively big bar and relatively tight range, reversals every few bars, so not good math for a scalp. Big bars, so big risk, and more of a trading range type limit order market. You can see the bears are sold below 68, lost. The bulls have bought above 69, relatively big risk. If you're a scalper, you can always buy for a swing trade. We're always in long, but I think it's better to wait for a better setup or for a strong breakout up or down. Back below last week's high. Still might be a little early for a buy the close or sell the close finish. A lot of times it begins at 12:30, 12:35. This is maybe a bar or two earlier than what is typical. Trading range, right? Anytime you see a breakout, you have to assume it's going to fail. Where you broke above 68, reversed down, or we broke back below the high of last week. Bulls trying to get a reversal up. Spike pullback channel. Next target for the bears is the 24 low, maybe the 60-minute moving average. One of the problems the bulls have is location on the daily chart. In addition to testing the February low, we're also at the 20-day moving average, which is resistance. For stop order bulls, they want a good-looking bull bar. So a 2-tick bull body is probably not good enough. You can see the 15-minute chart over here. Every bar or two reversing directions in breakout mode. 15-minute chart. It's just in a very tight range. What happens if 72 closes on its low well below the blue line and it becomes a pretty big bear bar? Then we're probably always in short, and we'll probably go down to the 25 low, maybe the 60-minute moving average. So important bar. It's an opportunity for the bears to demonstrate that they are in control. This is bar 72, a multiple of 12, so it's the end of the hour. And right now the bears have a bear bar closing near its low or a failed breakout above a 4-day trading range. Small buy signal bar does not look like a strong enough foundation to build a rally that will reverse 71. Not a helpful bar 72. The bears need a big bear bar closing far below the trading range, and the bulls needed a stronger buy signal bar. I still think the bears have not done enough to make it always in long and always in short, despite all of these bear bars. So I still think it's more bullish than bearish. The market's in that time window when, if it's going to create a trend into the end of the day, this would be it. So the bulls are trying to get a buy the close finish. The bears need an abrupt reversal down, which is not likely. They're running out of time. Bears trying to get another lower high, and bulls probably need one more bar to convince traders that it's going to be a buy the close finish. Trend lines are rarely perfect, but this is the general bear trend line. If you take the short, I'm not going to. I did buy about 73, and when it immediately pulled back, I placed an order to get out break even, which I did. A lot of times in situations like this, if I'm buying looking for a big move or a quick move and I get any hesitation, I just get out. And then if the big move starts right after I get out, I get back in. Right now, I'm not shorting 74 because we're at the bottom of the range, and also we're running out of time. But if we get a big bear bar closing below 72, I probably will sell as it's forming, or sell the close, or sell below it. What about buying above 74? I'll pull back from 73. I wanted 74 to be a pretty good bull bar, and I wanted there to be a sense of urgency. I wanted it to go up pretty quickly, like 39. Not much overlap, and did not get it. One of my general rules is if the market is in a tight trading range at 1245, I usually do not trade, because usually you do not get a trend beginning after 1245. Tight trading range and tail on top. It's still on the buy above 72, the buy above 73, now the buy above 75, but none of those buys is especially good. Also, the time is bad. This is an attempt at a buy the close finish, but it's starting very late. Can we make it all the way up to the February low? I don't think so. Not enough time left, and not much energy. Sideways for 4 hours. The minimum goal for the bulls is closing above the blue line, last week's high. The minimum goal for the bears is the opposite, at least one tick below the blue line. You can see how if it stays sideways into 1245, it's very difficult to make money except with limit orders at the end of the day. If you're buying with stops, your risk is big relative to your reward. That's because the market is probably only going to go your way for a bar or so, and therefore you have to scalp and you don't know how much you should be scalping for, 2 points, 4 points. But these bars are big, so you're risking more. And you win some, you lose some. Buying above 69, selling below 68, selling below 74. They're all losers, and you lose more on those losses than you make on the wins. And that makes it very difficult to trade profitably using stops in a tight trading range at the end of the day. So I rarely ever do it. I sometimes will trade with limit orders at the end of the day. In general, I don't like to do it. I prefer stop entries. But if the context is not supportive of a likely trend, I just wait. Today, I think we had several interesting things. Yesterday we had a bear trend, but the entire day I said, yeah, it's a bear trend. We opened on the high, we closed on the low, but we had a strong reversal up, and we had a weak bear trend, bear channel, and bulls made money all the way down. So bear channel, bull flag, you expect 75% chance we'll get a bull breakout. The channel may have continued more today, but we got the breakout on the open. We also broke above the moving average. I got to put in yesterday's high again. One of the annoying things about TradeStation, I got to say, I'm really inclined to switch, because there are so many problems with this new version of it. It makes me mad that they have not consulted traders. A lot of the design decisions were made by people who know nothing about trading. For example, when you enlarge a chart and then restore it, instead of the bar on the left being on the left, you get some other bar that's on the left, and you have to recenter the chart again, and then the trend line's disappearing. So I'm definitely considering switching to another platform. This is just not good enough. Anyway, so bear channel, bull flag, we broke to the upside, but a bear bar, and also 4 sideways days. So a lot of trading range trading. Bar 2 closed near its high, but the bar is not all that big. So it's possible that it's a trend from the open bull trend. We're probably always in long. And then bar 3, another bull bar, always in long, but possibly a parabolic wedge. 4, a pause bar. So we have a breakout, pause, breakout, pause. The bears needed one more push up for a parabolic wedge. They tried to get the reversal down at 8, but low 2, you can argue low 2, bar 5. However, bar 5 is not a bear bar, so and 8 did not close on that slow. So I think this is a minor reversal down. And then bar 11, surprisingly big bar. When you see a bar like that, you know the volume is big. You don't have to look at the volume. What was the volume? Volume was almost 80,000 contracts. We knew it was a big bar. We knew it had a big volume, just because the context, it was surprising to see that bar in this context, and it was a very big bar closing up near its high. So of course it had a big volume. And then we had a follow-through bar, bar 12. So at this point, it might be a second leg trap like yesterday, but I think much more likely it's such a dominant feature that we're going to get at least a small second leg up, 19, and probably the best the bears will get is a trading range. A bear trend is unlikely after this reversal in this context. So you have to assume it's either going to be a bull trend day, which it was, or a trading range day, which it also was. We were sideways here for 20 bars, and then sideways here for 30 bars. We had a relatively brief breakout, but even the breakout, starting bar 35, small bars, prominent tails, the absence of big bull trend bars, this looked like a bull leg in a trading range. So chances are there was going to be a reversal, creating a bear leg in a trading range, and that means another bull leg in a trading range. We're above the moving average, bar 45 or 45 bars. we knew almost 100% of the time we're going to come back to the moving average. We have a 9-bar bull microchannel here. Is it 9 bars, 8 bars? But a bull microchannel, so a climax, a spike pullback channel, a bear bar closing on its low. This is a good candidate for a sideways to down move to the moving average. So I would get out of longs. If you're aggressive, you could sell, knowing there's a 99% chance we're going to come back to the moving average today. And this is probably a good candidate for the start of that move. We could get there by going sideways for enough bars or by going down. We went sideways and down. The bulls had a high 2, bar 52, a 20 gap bar buy, a reasonable buy, and there probably are buyers below 52. The sell-off, we have consecutive bear bars, 50, 51, but more likely a bear trap and unlikely the start of a bear trend. We broke below 52 and then reversed up again. Once we went below 52, it reduced the chances that the bulls would be strong enough relative to the bears to get the market up to the February low. So, and the result was a trading range for the rest of the day. By going below 52 low, I think it just killed the bulls. We did not close the body gap. The close of 56, the bottom of that body, did not overlap the bodies over here, so the bulls still had a gap. But if you have a strong trend, a small pullback bull trend, and you get a pullback and you get a credible buy like 52, usually the bulls will not allow the market to get below that 52 low. And because they were unable to stop the market from getting below 52, the bulls were not all that strong. And that made it unlikely that we were going to go up to the February low. For stop entries today, you could buy above 2, not great. You could buy above 4, an inside bar after 3 bull bars. You can buy above 6, a bull bar closing on its high, outside up. And then we have the surprise bar, 11. On 11, you can say, well, we're still always in long. You can say, well, I got out of longs below 8. I got to buy again above a bull bar. And you can either wait for 11 to close and buy above 11, or you look to the left for the most recent bull bar, which is 7, and then you buy on a stop above 7. 12, we have consecutive bull bars right below a magnet, the high of last week. You can either not buy above 12, or if you buy above 12, put a stop below 11. If you did buy above 12, the bears have a sell signal, 13, for a second leg trap. But as I said, 11, 12 are so dominant, and the context is good for the bulls to try to get above. Last week was so close to last week's high that I thought this was probably not going to be a second leg trap. I think I said 30% chance second leg trap, 70% sideways to up. The bears got a couple attempts down, 13, 15. The bulls got a buy signal above 18. They had a high one buy above 20, but a bear bar and a third push up with 13 and 19. And you can also say a bigger wedge up with 7 and 13. 11, 12 likely to get a second leg up. It's possible that 18, 19 is that second leg up and that we don't get any more. However, I thought the best the bears would get would be a trading range. We got 5 bear bars, 24, a bull bar, and then a bear bar 26, so a micro double bottom, a double bottom bull flag with 15 right near the moving average. Not a great buy after 5 bear bars, but I think we're always in long. Some bulls would buy above 45, 46, others will wait and buy above 32. For the bears, they had head and shoulders top, left shoulder, head, right shoulder, with 3 bull bars, and the bodies are getting bigger. You know, and we had a tail on 31, so probably buyers below 31. So bulls buy above 32, above 33, above 34, above 37, 38, 39, 40, 41. And I would get out of longs. I would get out of longs once we started to stall around 42, but you could wait for a bear bar, 45, and get out. And if you're aggressive, you could sell below 45, but you probably have to use a wide stop to allow for one more small new high first. and then 48, a high 1. But remember I said, we're going to the moving average. So why am I going to buy about 48 when I know we're going lower? It's possible that we went a little bit higher and then lower, but odds were this was the start of a sideways to down move to the moving average. Bulls, another buy above 52. Reasonable buy for a bear trap. 50, 51. The odds were that we would go up, and the bulls wanted to buy above a bull bar. Excuse me. The management's a little tricky. Ideally, you'd put a stop not just below 52. You'd put it significantly lower. But realistically, if the bulls are in control, and if we are going to go up to the February low, the bulls will not allow the market to fall below 52. And it did fall below 52, and that made it unlikely to go up to the February low. We had 3 bear dojis, 53, 54, 55. Disappointing, but it's not enough to make it Ocean short. We have a reversal up 58 for another buy above 58, buy above 59, buy above 60, a possible double top 53, double top 49. And the bulls are not getting big bull bars. So this rally up to 62 looks more like a bull leg in a trading range, just like the sell-off looked like a bear leg in a trading range. And the bulls are bought above 59, probably disappointed 60. The bulls are bought above 61, probably disappointed 62. And they gave up 64. And then sideways here. I don't want to be selling at the low. You can see we broke below last week's high again, 72, reversed up, but a weak buy signal bar. 73, a better buy signal bar, but too high up in the range. So I don't think it was always in short at any point today. I think it was always in long from bar 2, bar 3, and stayed long. So realistic buys above 2, above 4, above 6, above 11, above 12, below 13, realistic sell, but it's probably going to fail. Buy above 18, buying above 20, third push up and a bear bar. I usually do not take that buy. Selling below 21, reasonable because of the wedge, but more likely a minor reversal. And then buying above 25 only after you see 26, because once you have 26, you have a micro ripple bottom, and then it's a buy. And selling below 30, no. Buying above 32, yes. Above 34, yes. 37, 38, 39, 40, yes. 41, probably. But I think we're going to get a pullback to the moving average soon. Selling 45, only if you can use a wide stop and scale in. Buying above 52, yes. Ideally, if you can buy more below 52, but most traders would just get out below 52. And then buying above 57, 58, 59, and then 60. I'm becoming concerned. We're not getting big bull bars. So this might not go up very far. And then buying above 67, the bar is too big, the risk is too big. Selling below 68, the bar is too big, the risk is too big, and we're at the bottom of a trading range. So this is not reliable stock order trading. Buy the close, sell the close. Well, officially it's buy the close, bar 3, consecutive bull bars with decent bodies. So buy the close 3, 4, 5, 6, 7. If you buy the close of 7, I would get out below my bear bar 8, and then buy the close 11, 12. It's probably even buy the close 13, and then 18, 19. It's buy the close, but bulls disappointed 20, and they got off break even on 21. Buy the close probably 34, 39, 40, 43, 44. Buy the close, but I would get out below 45. Buy the close 59, disappointing 60, 61, 62, and that would be it. Limit orders, well, the highest probability limit order trade today was buying the 5 low. We had a 5-bar bull microchannel, 4 consecutive bull bars, so probably buyers below. Probably buyers below 7 as well, but your stop is below 2, not below 8. And then up here, you might sell above 20. I'd rather be looking to buy a pullback. And then through here, you got 3 bull bars, so probably buyers below 29. You have a weak failed breakout 34, so probably buyers below, probably buyers below 35. 48, I thought there would be sellers above, and that we'd go sideways and down to the moving average. Selling above 51, I would not. I think this is probably a bear trap in that we're going to go up to a new high. And what about buying below 53, buying below 52? The math is probably good, but I don't know that it's worth it. And then here, really not very good trading. Even for limit order traders, it's a lot of work, not much profit. Question about the gold miners, the miner on the GDXJ. Okay, just a cup and handle breakout. Well, we got a double bottom. We have a reversal here. So anytime there's a reversal and a pullback, you have a cup and handle. So there's a handle here and a handle here. And you could say the whole thing is a reversal. I would call it a double bottom and a breakout above the neckline of a double bottom. But anytime you get a reversal and then a pullback, you have a cup and handle. If I were trading this, I would be long with the stop all the way down here, maybe down here. And I would be concerned that the market was sideways here for a lot of bars. And therefore, if we get there, we'll probably stall. So to me, it's still long, double bottom, neckline, magnet, a little bit above, but it's probably not going a lot higher. So depending on, so if I were trading it, I would be long, but I would be looking to take profits pretty soon because there's resistance just above. Good question. After becoming profitable, after how many contracts should the orders be split to not be obvious? 50 contracts, 100 contracts, always maintaining 1% risk. No one's going to care. Nowadays, 20 years ago when the E-mini came out, I thought that the market was chasing 20 contract orders. Now I think, you can trade 100 contracts and you're still small. There's a higher chance of the market going after 100 contract order than going after a 25 or 50 contract order. But I personally would not worry about a 100 contract order. The bigger your position size, the more you have to swing trade. And the further away your stops will be in general. And therefore, there's less risk of the market going after you. And the reason I say swing trade is if you're starting to trade 100 contracts, not so much 50 contracts, 25 contracts, but around 100 contracts, the chance of slippage is greater, and that creates a problem if you're scalping. So, but in general, if you're trading 100 contracts, you should be switching into more and more swing trades, fewer stop entry scalps. But personally, I would not worry about 100 contracts. I remember Paul Tudor Jones talked about this when he first started managing money. He manages, I don't know how many, he's got a hedge fund with several $1 billion under management. And he began as a cotton trader, I guess 30 or 40 years ago. And then he traded E-minis. And in his fund, I remember when he was saying that, okay, my fund is big enough now, I have to start trading 1,000 contracts or 2,000 contracts. And I'm going to split them into lots of 500. So that was 20 years ago. So lots of 500 20 years ago would be lots of like 2,000 today. So I personally, for an individual trader, I would never really be concerned about getting too big. However big you think you are, you're really not that big. So even 100 contracts, you could probably do a lot of day trading with 100 contracts. The market could probably absorb that most of the time. in a really quiet day where the ranges are small, much less so. You probably do more limit order trading, but on an average day, most days of the year, I bet you could trade with stops and do just fine with 100 contracts. Okay, question, could you give me your thoughts on the relationship of or usefulness of the Globex moving average compared to the regular session moving average? I knew someone was going to bring this up. I didn't know, but I thought they would because of the moving average right here. Okay, we did not get to the moving average here, but the Globex 5-minute chart did. Okay, so let me take a look. This is at 840, and let me put up the Globex chart at 840. Okay, you can see we did not touch the moving average here or here on the day session chart, but on the Globex chart at 840, look, we touched it. My thought is, I don't care, right? I choose one chart. I could look at the Globex chart. I could look at a 3-minute chart, a 1-minute chart, a tick chart with 1,000 ticks per bar. I could look at any kind of chart. I could look at the NASDAQ, the Spider, the cash index. I could look at the Russell. I could just trade Apple. I could trade Amazon. I could trade Bank of America, XLF, XLE, crude oil, bonds. It doesn't matter. And on all of those charts, every day, there are probably 20 or 30 trades on every one of those charts. And I'm missing every one of those trades. And I don't care because I see so many trades on this chart. I can make a good living from this chart without worrying about all those other charts. And therefore, I don't care. Whenever there's a big gap up like this, you're always going to have differences in the moving averages for the first hour or two between the 5-minute chart on the Globex and the day session chart. And I know that. And but I don't care. I see enough on this chart so that I'm not going to look at other charts. I'm not looking at the 3-minute chart and the 2-minute chart, the 1-minute chart, or all those other charts. They all have signals all day long. I don't care. I have enough to do with this. I don't need to have more trades. If I was your age, I could easily take 40 trades a day from this chart. And do I need 41 trades? Do I need 42 trades? No, I don't. Do I need 100 trades? Do I need 200 trades? Looking at all those other charts. No, I couldn't do it. Plus, it would not be fun. I have fun doing what I'm doing, and I'm not going to make any more money adding a whole bunch of other charts. So long ago, I just resigned myself to just trading one chart, and I don't care what the chart is. I could be a crude oil trader. I could be, a gold trader. It doesn't matter. I'm going to trade them all the same. However, if I'm a day trader looking for lots of trades, it's not practical to be looking at more than one chart. You start seeing conflicts and you start missing things because you're distracted by another chart. So I'd rather just trade one chart and trade it as best as I possibly can trade it, and just trust that I'm going to be fine and not worry about what's going on the other charts. All right. Hope everybody has a good weekend. Looks like we have more to go. My thought on the daily chart is the market typically likes to rally to the top of the sell climax, possibly here, possibly all the way up here. And if we get all the way up here, then traders are going to start to say, the correction's over. That's too far up to be a bear rally. It's probably the start of a bull trend. I'm assuming that we're going to go higher than what people think, and that we're in for a confusion, which means a trading range for the next month or two. All right, hope everybody has a good weekend.